Welcome to the Real Money Show, the number 18778 Silver, the website guildhallwealth.com. Thanks for joining us this week. Today we're going to talk about the debt ceiling, have a discussion on that. We're going to talk about CNBC, what they think of silver recently, because they just put out an article. The World Economic Forum wrapped up this week as well, so we've got some takeaways. And Jerry's going to discuss why central banks continue to buy gold. And as well, we'll take a look and get an update on de-dollarization throughout the world. But first, let's ask a question. I think it's time for tough questions at this point, with inflation still running very hot, and time will tell if the Fed can squash that forever, or if it would be temporary if they do end up being able to get it under control. The first question I think that we really have to ask ourselves as Canadians is, do we really believe the stock market can go higher from here? Can it double from here in the next decade, after more than a decade of gains, obviously because of low interest rates and money printing and all of that going somewhere? The question is will the stocks double from here over the next decade? Is it possible for the Dow to go from 34,000 points up to 68,000 points in the next decade? Something to think about. Will real estate prices go higher from here? We're going to bring you some articles from Better Dwelling and give you an update on Canadian real estate. But you've got to start asking yourself, is that going to be where the equity is going to build over the next decade? Is it going to be in real estate? Jerry, just before the show, you talked about GICs. People are looking for safe havens. Mm-hmm. Are GICs really a safe haven, or are they just a fool's paradise? Let's get into GICs as well. And most advisors, we're not advisors, but we understand most advisors will say, well, hold on for the long term. It's all about holding on for the long term. Is that going to work this time? We've got to think about all of these things. Of course, gold is something that is starting to trend higher. It's just starting a bull market. Now, some could say, Jerry, we hit the bottom in gold in, I think, 2015-16, around $11.80, $11.50 an ounce. But it certainly feels like the bull market's starting around this time. And I was listening to an interview with Michael Oliver, who's a great analyst in this market. And he does, I think, more on the mining stuff. But he made a great point that over the last 50 years, gold has had 3 major events in markets where it moved up 3-4 times. Multiplied. You had the early 70s where it went from 71 to 75, from $35 to $200. It was a huge gain when you think of it multiplied. You had the run in 1980 when it went from the low, I guess it was trading around maybe 200 or under 200, and it got to 850. Again, massive moves. And then you had from 2000 to 2011, where it ran from a low in 99 of $250 up to over $1,900 in US. And here we are. The market started around $1,200, let's say, in this bull market. So do you agree with Michael Oliver that this market could have a multiples run over the next several years?
Fairly confident to say that it can. Gold has proven itself throughout history, throughout the decades, going back 100 years. The cycles are pretty clear in gold. And when you have a market that has clear cycles, and charting the cycles is one thing, but to understand what was going on fundamentally, what was going on in the world during that time, to couple with the chart patterns makes a very compelling argument that yes, we are at the cusp. As I mentioned before in many topics that we discussed, the trends in gold and silver specifically, every 3.5 years we do see a peak. And the last peak that we saw in both gold and silver was 2020, where gold hit all-time highs. And now that we're back over 1900 and silver playing with this $24 level, we're watching the US dollar break down. And this is the fundamental matter here. What's going on in the world? It's a massive de-dollarization. The world is moving away from the almighty US dollar. Why? The trust is gone. Where can you find trust? Physical gold cannot go bankrupt. It can't default on promises or obligations. When when we are giving away our trust with promises, and these promises are turning sour and dire, look at the portfolios over the past few years that we saw, Jeremy. Double-digit losses. Some were up, but most were down.
Yeah.
So I think this cycle will continue in gold, and I think where we are right now, it's launchpad time.
Yeah, and just to think about where things have gone in the last couple years from 2020, what's happened with the money printing? It went nuclear in central banks and government spending, absolutely nuclear. And now we're dealing with the fallout. I think a lot of people think this inflation came out of nowhere. It didn't come out of nowhere. It's been building for a very, very long time. It's just gone from stealth to kinetic.
It's transformed a few times.
Yeah, and sure. but definitely over the last several years, we know what's been going on from a monetary perspective, from a government debt perspective, and there's going to be major consequences. So you have to think about, well, how do I protect myself? Well, let's talk about GICs. Is GICs a good place to protect yourself? The way the GIC works is you're going to put your money in there for a while. They're going to give you 5% for a year or 3 years. But with an inflation rate of a real world inflation rate comfortably over 10%, how can the promise, and a promise being comfort to a fool, how can the promise of 5%, but I'm not losing, be something that someone would want to sign up for?
I know. Well, that's what's going on. We're going into the bank. We want to visit a financial planner, our trusted financial planner, and we ask, I'm scared about the markets. I'm seeing a lot of losses. I'm hearing a lot of things going on. I need some safety. They pull out the GIC. I'm going to offer you 5%. A rate that you haven't seen in a very long time. 5% is very enticing, sounds very safe. Let's do it. Let's lock up some funds in an RSP for 1 year. Lock it up. You get 5%. Real world inflation. Let's open it up. Let's have a look. Let's use the calculation that we once used back in the 1980s of the real world inflationary. We're actually at about 16%. So you're given 5% with the GIC. Real world inflation is down 16%. So you're losing about 11% in purchasing power. 1 year later, at expiration, you jump right back into the same sinking boat of the Canadian dollar. You didn't solve a problem. Has inflation ended? No. The inflationary narrative right now is we're being told it's dropping. It's getting better. The Federal Reserve is doing its job. We can slow down. February 1st is Federal Reserve Day, where they're going to be raising interest rates, and they've basically baked into the cake 25 basis points because inflation's getting better, Jeremy.
Okay, I want to stick with GICs for just a second. So if someone comes to you though and they say, okay, but gold in US dollars was unchanged last year, it's going to cost me 5 to 7% round trip to get into the market. I may potentially be paying storage fees. I'm going to be spending all this money on my gold. Well, why wouldn't I just stick with the GIC? There's no costs and just interest to me.
Well, gold is your counterparty risk. This is where I come at it with gold being your wealth insurance. When you want full insurance, a full insurance policy, you pay for it. You want zero counterparty risk. You don't want to have an inch of risk dealing with, let's say, house insurance. You're going to get the full policy to ensure that your house is kept safe. As far as your financials go, you don't want to meddle with something that has counterparty risks. And to go with something like gold has proven itself throughout all crises. It's proven itself as the go-to asset class, and this is what we're seeing right now: is a rush. Look at what the big money's doing. They're going into gold hand over fist. 2022, we saw net imports from pretty much all central banks that matter into physical gold. What are they seeing? What risks are they seeing, and why are they going towards the expensive gold? Well, gold may seem expensive right off the bat. It's definitely not day trade where you want to do a quick flip that you were once used to with a crypto. This is not a time to play with your wealth. We're not playing here. This is park it into gold. Yes, there is minute costs to get involved. Storage fees. You're owning something physical, like a boat. You got to pay for your dock.
I think of it as, obviously you're not going to hold gold for 1 year. It's something that you're going to hold for a while, and you're probably going to, at some point, adjust your portfolio in terms of a percentage that you're holding. So that's going to change down the road, but it depends when you're acquiring the gold. Even if you acquired at the top of a market at a certain point, gold will eventually overcome that top. I spoke to a client just this morning. He acquired a significant amount of gold a couple of years ago at near the highs at the time. Now, I'm not saying it was at the time of the year, but it was definitely at a higher point in terms of the trends, right? So he's sitting there and he said, you know what he said to me, Jerry? He said, so we reviewed, and it's been about a couple years, and he's broken even. He's just in the green, a little ahead. If he wanted to sell, he'd be ahead. But what he said was, gold held in there last year, and my stocks were down 7%, and I think I did better than most people with it being down 7%. But gold was unchanged, and that's a good thing in my mind. I didn't lose on gold last year. And I think we're about to move much, much higher. So I'm glad to have it. So again, this comes down to the promise of a short-term return of a year or 3 years versus what gold can do over a 5-10 year period as it breaks to new levels. So you're going to overcome those costs, definitely. Give us a call. We're happy to run the numbers with you about how to get involved in the market and what these things cost and how little it actually cost to get involved in the gold and silver market. The number 1-877-8-SILVER, the website guildhallwealth.com. Let's talk about the real estate market in the next segment. Is it destined for higher moves, or should we be bracing ourselves for lower ones? It's the Real Money Show on AM 640. Welcome back to the Real Money Show. The number 1-877-8-SILVER, the website guildhallwealth.com. And Jerry, listen to this, some information that came out. Existing home sales in the States fell for the 11th straight month. Now, over the last, I would say, 6-7 years, maybe 8 years on the Real Money Show, we've been tracking Canadian real estate, and we've talked at length about the how much is going into real estate, how much debt is going into real estate, how much of people's earnings are going into real estate. That, it was once upon a time you put up 10-15% of your earnings a year to your accommodations. Now you're putting up north of 30% as interest rates rise. If you have a flex mortgage, whatnot, this could be even higher. And I thought, since this information came out just today about existing home sales in the States, let's check in with Better Dwelling, which is a great blog if you want to find out. It's not always doom and gloom, but I think they're pretty impartial. But listen to some of these headlines, Jerry. Canadian real estate prices to continue falling in the near term, according to RBC. This is just headlines, January 18th. January 17th, Canadian households see a big drop in real wages ahead, Bank of Canada. This one comes from the 16th of January. Canadian real estate prices haven't dropped this fast since 2009. Here's another one. The Canadian real estate industry forecast expectations are crashing. And then finally, another one from January 15th. So these are all recent. This week's top stories. Canada's bank regulator wants tighter rules as real estate prices crash. So the question here is, knowing what's happening in existing home sales in the States, knowing that we're in the midst of a pullback in real estate, let's not take the real estate agent's point of view, and it's always rosy. Look, it's coming down. It's happening. Is it going to get worse is the question, or are we going to dodge a bullet this time? As
we're homeowners, we want to stay as optimistic as possible. But with regards to the pricing and the conditions, joblessness, and even crime, I don't see that the sustainability of the property market can remain when the banks are tightening up, and when you have to go in for a renewal or a refi on your mortgage. try to get that money. I had a client that was supposed to, that really wanted to put in a sizable amount this week, or rather next week. And closing was supposed to happen last Friday, just after the taping of the show. The financing fell through. This was the situation. They put on so much more credit card debt over the past 2 months. People are just cash strapped. Credit is at an all-time high, I believe, in Canada. I saw a chart yesterday of the amount of credit card debt that the Canadians have put on. We're overloaded in debt. And this is one bubble that has to correct or pop. This is something that we'll likely see. Your father, Paul, he mentions all the time what he's seen back in the day. And this is very much like what we've seen before, but much worse.
And, if you take that and you add to it, in this, again, the news coming out about layoffs, Microsoft laying off 10,000 people, Google laying off 12,000 people, Amazon laying off 18,000 people. How many of these people were contributors of a 2-income household to a property, and if their interest rates just go up? I can't help but think that it's in the mail. It's coming down the pike. Name your metaphor. It's coming. Mm-hmm. It's coming. You can see upon the horizon the storm. And I think even someone who said it on Fox News, the storm's coming. Mm-hmm. I think even JP Morgan has talked about that. I don't think we can have a rosy outlook. And so how do we become defensive in this market? How do we protect our wealth, but maybe not just sit there, survive? How do we thrive as well? Mm-hmm. Isn't this an opportunity to also take advantage of what's happening in the markets?
Yes, in all reality, this is really stagflation 101. This is the word for 2023 and going into, I believe, the next decade. What is in your portfolio that will protect for today's stagflation? We talk about what happened in the 70s with very low growth, very high inflation. It's the same equation of what we're seeing today, but much worse when we're overloaded with debt and concern and hopelessness. What is in that portfolio? Well, stocks did not perform during that time, but what did? And survive, yes, with gold, and thrive with gold is your key, is your hedge for this decade. I think in the next 3 to 5 to 10 years, gold will be that outperformer. Gold will change lives of many people and allow to find true protection, not in a GIC. I truly believe that gold will do this. And I brought to the table what gold did during stagflation during the 1970s. During the 1970s stagflation, gold had a decade long of stellar returns. So no, not a day trade. You buy your gold. And what happened during this cycle? Again, gold is very cyclical. Gold prices soared from $35 an ounce to $681 per ounce in January of 1980. That is a massive 838%, eightfold on your money in a decade. And silver went up 11-fold during this period. So what is in your portfolio that will help us to survive and thrive? It's very clear. And I think with this market, you're understanding history at the same time. It's a great history lesson with gold and with silver. I was just the number 18778 silver, the website guildhallwealth.com, and we're going to get into silver, of course, too. But it's funny. I was talking to someone yesterday who's helping us doing some writing on our website, and we were talking about gold and the fact that we really encourage people to crawl, walk, run, meaning just get started. Pick up an ounce of gold, pick up a tube of silver maples, a 10-ounce bar of silver. Come to the office, get that physical product in your hand, and because there is an aha moment that happens where you realize, oh, I'm not investing. I'm converting my useless fiat currency into hard money, which is an asset and it's ownership. I'm owning. I'm not investing. Right? I was even saying to someone, you're seeing a lot of people voting with their money these days, right? They go, I don't like what this cable network what their content is. I unsubscribe. Right? Yeah. You're always talking, Jerry, about undigitizing. I got a new one. Unsubscribe.
Unsubscribe from the
unsubscribe
currency
button.
Hit the unsubscribe from your currency button
Yeah.
and get into the hard asset. There's an aha moment that happens, a paradigm shift. And as that happens and you gain more comfort of acquiring more. Maybe you decide, okay, I'm going to buy some physical. Now I'm going to put some in my TFSA. You know what? I have this lira that I've not used. And by the way, it's down 10, 15%. I want to convert that over to you guys and get into the physical market because I see where this is going. And we were talking about that. And we were saying, it's funny because it's sort of like at each level from the crawl, walk, run, there's like a certain enlightenment that happens with regard to your understanding of money. And understanding of how finance works. And, that's why people ask us all the time, I don't want to digress too far, what do you think of cryptocurrencies? And I'm really at the point where I'm like, don't ask, because I'm a gold guy, and I'm going to give you the gold guy's perspective, and I'm going to tell you what money is and what a currency is. So go have fun.
Yeah.
They're different parties. But someone is borrowing a lot of terminology and a lot of right. Nonetheless, you know what? Let's talk about the debt ceiling.
Yeah, big one.
What's going on with the debt ceiling?
So what is this debt ceiling issue? So that happened this week, January 19th. It hit the U.S. hit their debt ceiling limit. The debt ceiling was created in 1917 under the Second Liberty Bond Act, also known as the debt limit or statutory debt limit. The debt ceiling is set by Congress in the States and is the maximum amount the U.S. Treasury Department can borrow by issuing bonds. And when the ceiling is reached, they must find alternative ways to pay expenses. The debt ceiling applies to most federal government debt, bonds and bills. So basically, it includes both debts held by the public and what the U.S. government owes as a result of borrowing from various accounts. So it's a lot of slushing of money around.
I did hear recently that the Treasury is having to really juggle right now as they approach the ceiling.
It's getting ugly. It's definitely something that we're going to probably be seeing for the next few months. They have until June, but they can definitely be pushed till September is what I'm reading.
Was it you that was telling me that Janet Yellen was saying we're already becoming illiquid?
Yeah.
And that they're basically going to start, I'm paraphrasing, but defaulting on pensions?
Yeah, that's one of the extraordinary measures. So over the course of history, it's important to understand that we've seen this 78 times since 1960, this U.S. debt ceiling being breached. The most recent time was in 2021 to 31.4 trillion. The debt ceiling went from just under 1 trillion to nearly 3 trillion in the 1980s and has roughly doubled every decade since. The 1990s saw it at 6 trillion. So it's just an ugly show, and it's just a big drama.
It's a little bit like a jar of jelly beans. Mm-hmm. They started off in the 70s, 80s of raising this thing, not being fiscally responsible, and they go, let's just eat a couple of these jelly beans. It's okay. And then they turn around after watching a few episodes of Yellowstone, and they've eaten the whole jar. The jar's gone. We raised the debt ceiling umpteen times, and I've run out of jelly beans, and I think that's where we're at right now with this current Congress, because they've sort of threatened that they will not raise it, and the question becomes: is that just a threat to maybe negotiate? Mm-hmm. And I do think that they are going to be more fiscally responsible. I don't think they're just going to let out these massive packages.
No,
and I think it starts with the debt ceiling of saying, okay,
let's see.
Maybe we'll raise it,
mm-hmm.
but you better be showing us how we're going to fiscally responsibly do it. What do you think? Do you think they're going to just go, no? Or do you think maybe there's a negotiating going on here?
Well, the House has never been this divided. Now with the House being in control with some fiscally conservative people, some folks that, very much like Ron Paul, who wanted accountability from a very long time. And they're going to be using this as a bargaining chip. And if you could just see clearly how split that this 118th Congress is visually in how they vote, you got a lot of divisiveness here, but a lot of control with those who want to see responsibility, fiscal responsibility.
But what happens when there's this type of fight on it? What happened the last couple times that we've reached this kind of fight on it?
This is something that has gone very wrong in the past. The odds of something going very wrong like what we saw, the odds are, increasing that something will happen like what happened in 2011. Very high. And what happened was the S&P rating agency downgraded the U.S. ratings from AAA down and sent the stock market tumbling. And this can be that trigger. I believe that, this is another black swan event potentially for the stock market. So we have to be very, very hedged up and out of any stock market risk.
So it might be an indication that in terms of timing, not to put you on a rush, but this could be something that could affect the market in a big, big way, at least temporarily, until we can figure out what happens next.
They said anytime between June and September. So there's a long time between now and then.
Yeah, the number 18778-SILVER, the website guildhallwealth.com. Let's get into the silver market and how exciting that is in the next segment on The Real Money Show on AM 640. And we're back to The Real Money Show, the number 18778-SILVER, the website guildhallwealth.com. Okay, so you've heard us talk for a little bit here, and you said, maybe I'll take a little step into this. How do I do that? You can go to our website. We have an e-store, guildhallpreciousmetals.com. You can log on from the comfort of your home, or you can make an appointment, come to our offices, or you can just call us direct. You've got the number, and start small. Pick up an ounce of gold, maybe a tube of silver maples, 10-ounce bar of silver. You're going to get a sense of what this is when you do that, and then you can move from there. We offer physical storage, so if you're looking to put in a large amount of physical gold and silver and you want a place to physically store and secure that, we work with Brinks, fully allocated, fully segregated accounts. What does that mean? It means you own it. It means you're not sharing that product with anybody. There is no counterparty risk. And the best part is you have liquidity. You have the ability to be nimble. Need to sell that product? You can do that. Jerry, I have a client who is out in Mexico, and out of the blue, they decided, you know what? We're going to buy a house. They're liking it so much, and they need funds pretty quick, and we were able to liquidate their product and get them out of the market so that they can acquire this property. So that's just an example of how liquid the market can be. And you can do that as well in your registered account. The vehicle we have for the registered account is unfounded. What we're offering people is the ability to have their own hard assets owned by them, held in a vault facility outside the banking system. They physically own the gold and silver, specific products that is listed in their sub-account. That's right. They get their own sub-account. The numbers are listed. They get an inventory report. It's basically a warehouse receipt. And then you log on to your Questrade account onto the portal, and it looks like a stock, except that you know that it's a hard asset in a vault outside the banking system, and you own it. No counterparty risk. If you decided, hey, you know what? I'm going to pay my withholding tax on my RSP and take delivery, that's what you get. It's your product. There's an administrative fee, maybe a shipping fee, but it's your product. None of this, oh, so you want to take delivery? Okay, well, you see, you've been sharing a 1,000-ounce bar of silver with 10 other people, so we have to actually go out and buy that 100-ounce bar, which is going to cost you an arm and a leg, because you never actually bought it, and you know that, right? So, so this is the thing. You want that security right out the gate. You want to have that lack of counterparty risk out the gate. You do not want counterparty risk in a market that the dominoes could come from anywhere. That last card that makes the whole house of cards fall could come from anywhere. That sticky Jenga piece, we just don't know where it's going to come from. So we want to protect ourselves. We want to help our clients protect their wealth and their family's wealth and their retirement wealth. I don't think we have time, Jerry, to take our advisor's advice that we should just hang on for the long term. You know, I remember Kiyosaki getting on CNN in 2008 saying, I'm, 60 years old. I don't know if I have time to see my portfolio return. Now, he's a guy who lives off passive income. He's a real estate guy, and he's always been a big gold bug, and he's definitely excited about the silver market. So those are the ways you can get involved. Give us a call. Before we get into silver and how even our mainstream mortal enemies, Jerry, of CNBC and what they think of silver going forward. Let's talk about the wrap-up of the Davos crew. World Economic Forum. Seems like everybody is starting to know about World Economic Forum. In the past, it was literally just, you had the guys from Bloomberg saying, oh, we're in Davos. It's all the rich people and they really know what they're doing. And now you have Rebel News chasing up all these people. And it seems like some of these leaders are even scared to show up.
Right.
I have a client who puts X's on the leaders that have stepped down since then. But it seems people are finding out about the World Economic Forum but we get to find out what their plans are for the future. And yet you have a summary of a different kind coming out of the World Economic Forum.
Yeah, I mean, it was quite the week-long events at the World Economic Forum, where most of the focus was on ESG and the environment and climate change and how we can form the new world order with Klaus Schwab's vision. And our very own Deputy Prime Minister was there, Chrystia Freeland, pledging more funds to the Ukraine. Whereas there was a key takeaway for me, Jeremy, regarding the collapse of the petrodollar. It's coming sooner than you think. At Davos this week, specifically, I think on Wednesday, the Saudi officials were there, and they confirmed reports that they're having discussions to trade in currencies other than the US dollar, as well as focusing on strengthening the relationships with key international players, notably China. So as these players are talking about the central bank digital currency and want to push these fiat unbacked digital currencies, we're seeing the two major players here with oil barons, from Saudi Arabia meeting with China. And this is the nail in the coffin as it relates to gold, because we know that gold is negatively correlated. It does move in the opposite direction of the U.S. So we have to watch what's going on in the U.S. dollar, and the U.S. dollar's dominance and hegemony that it has had the rights to over the past few decades was because it was backed by oil, or oil had to be traded in US dollars. So that's what gave the US dollar this supposed strength and dominance in world trade. But now you have Saudi Arabia saying, not really interested in that anymore. We're going to go along with our friends over here. It's causing fragmentation, and this world's being fragmented. And that's what the IMF chief was actually talking about this week, too, talking about inflation's continuing, guys. I don't know about this narrative of seeing inflation going down. That's a transitory speech. But what's going on in the world, it's de-dollarization, and we're seeing Saudi Arabia, the petrodollar has now shifted to the petro yuan. So they're making arrangements, and it's happening fast. And as a result, these central banks are making moves as well. The central bank digital currency being a gold-backed digital currency with Iran and Russia. So we have a backed digital currency as opposed to the World Economic Forum's unbacked fiat digital currency. I wonder which will win, Jeremy. Which one do you think will be that one that will survive? Well, one thing for sure, an alternative to this global currency, we'll need to find something to back the system, as our cryptocurrency neighbors have found that out really quickly in terms of liquidity. You need a commodity that every nation will need more of, and that would be gold. All nations are heading to gold. All central banks head to gold. Any financial restructuring heads to gold. Jeremy, your thoughts?
Well, this is why you're seeing a drain of physical gold off of the exchanges, because it's going east and they're making these plans, and they're going to win. And clearly they've been listening to the Real Money Show.
I think so.
Because we've been telling everybody that gold is the bridge out of these currencies that are going to be worthless. And they're worthless because of all the debts. So great to see that they're taking our advice. Though we don't give advice here, but they've been listening. Mm-hmm. They're, Putin and crew have been listening, and China has been listening to the Real Money Show, and they now know to get physical gold to protect themselves against digital-backed digital currencies. The number, 1-877-8-SILVER, the website, guildhallwealth.com. In the next segment, we're going to talk about what our mainstream masters have to say about silver. Coming up on the Real Money Show on AM 640. Welcome back to the Real Money Show. The number 1-877-8-SILVER, the website guildhallwealth.com. Jerry, it's always great when the mainstream can't help but come to our side. And even if it's begrudging.
Capitulation.
Here's an article that came out yesterday from CNBC. Silver prices could touch a 9-year high in 2023 with a bigger upside than gold. Some of the key points in the article, they cover the fact that silver could hit a 9-year high of $30 per ounce this year and become a better performer than gold. And their basis for that, which I think is something we should be chatting about right now, is the insufficient supplies of silver as well as its tendency to be a better performer than gold in periods of high inflation. So I agree with them. I can't help but agree with them. Could it go higher? Sure, it could go higher. We've had some outlooks so far, first couple weeks of January, where a lot of analysts said silver could easily get into the mid 30s, which would give it a monster gain from where we started. I think in the $23 range, $24 range. So that would be massive, and I think anything over $30 and we're in a new territory. Wouldn't you agree, Jerry?
Yeah, this time around, anything over $30 silver is going to be a clear boost forward. Why? Well, around $30 was the last peak in silver. And we have to remember what happened at the last peak in silver. There was pandemonium. There was a lot of uncertainty. There was COVID. There was a lockdown, supply chain issues. We saw premiums on the inside here with regarding to wholesalers raising their premiums. So there was a lot of excitement. So we did see silver break $30 plus. This time around is much different. They've already exhausted all of their fuel, all of the stimulus, all of their measures to try to quell worries and ease
tamp down the prices.
Yeah, tamp down the prices. This time around, the momentum's done. They've already exhausted everything they can. They've raised interest rates, which helped tamper those prices down. The market has already priced in 25 basis points. It's very clear that the Fed is tapering their rate hikes, and markets are now betting that this year they're going to be halting altogether. And this is what's bringing the US dollar down. Last week's show, we were at 105 US dollar index. We're right around 101 today. Once the US dollar breaks below the 100 mark, this is all psychological now. The US dollar is going to break down. On the top side, precious metals, including our very own, the white metal silver, is going to take off over $30 into, I think, in the next 3 to 5 years into all-time highs.
Oh, yeah. I think that, going back to what we said right at the beginning of the show, looking back on gold's performances in 3 bull markets over the last 50 years. So it's not out of the realm of reality of us entering this bull market now. The demand from the BRIC nations is monstrous. The drawdown in inventories is relentless. The fact that the product is being bought by central banks so consistently, they're all preparing for what's going to happen. And as we've said dozens of times, he who owns the gold makes the rules. And I've started to hear smatterings of analysts talking about India's been acquiring silver and other countries are going to start acquiring silver. This is something unheard of over the last decade, of central banks potentially buying silver. And they're going to come to the table and say, oh, you guys want a commodity-backed currency that we're all going to agree on? Well, we want silver as part of that basket. Well, what happens to the supply-demand fundamentals when there's what? Let's say there's 2 billion ounces of silver at best. Okay. You've got 8 billion people on the planet. You've got 5 billion ounces of gold, and you use silver in anything that's electronic or digital. And there's already running deficits. Mm-hmm. And now you want to have it as part of the monetary system. Mm-hmm. And it's super, super cheap. Like even at $100, it's cheap. At $150, it's cheap. There are stocks trading more than $300. So even at $300, it's cheap. Because in a couple of years, you're going to say, well, what does $300 buy me? Mm-hmm. It buys me an ounce of silver. Maybe I should get that. Yeah. So in our business, everybody buys at the top. The masses. We've been blessed with savvy buyers.
Yes.
People with their eyes wide open to what's really going on in the currencies, in the finance and politically, and saying, I need I need that golden shield, just like the shield we put in our logo. It's the golden shield. I want the bridge. Great to see the central banks listening to the Real Money Show. And they're looking at a way to get out. They forget the counterparties.
Yeah.
Forget the counterparties you want to have in this market. And silver, with the industrial side, with the fact that it's so cheap, yes, it can go to 30. Once 30's been that resistance for what feels like forever, to the point that you and I even discussed this kind of like Stockholm syndrome. Like if it breaks 30, we won't even believe it. But it's going to happen. We know it's going to happen. It's inevitable. It is inevitable. And you have an opportunity to get it below. And even when it breaks, that's fine. We're not at 50. But we're not going to start talking about $50 and $150 silver and $300 silver till we break this $30 mark. Once we do, I really feel personally that it's going to be a whole new game.
Yeah.
A whole new game.
I mean, 2023 has already started with tremendous momentum in the markets, building from the 2022 momentum that we left off with. We left off the year in gains in pretty much every single major currency. It's continuing to go. As we see our central banks blunder, every central bank is just bleeding, really, just fumbling and bumbling. All they can do is really talk up the microphone. All the central banks, they're acquiring the gold because they're really preparing for this unprecedented period of monetary devastation and monetary restructuring. I couldn't help but remember in 2008, there was a credit crunch and a liquidity crisis. And that put in, talking about supply and demand in gold and silver, that put a dent in the gold, the producers' capacity to secure financing for new projects. So you're going to get a slowdown in supply. So you get it while you can get it, because once that price goes to unobtainium, I think precious metals, specifically silver, is going to go into lands and leaps and bounds into prices we have never seen.
The music's going to stop. You got to have your chair. You want your safety boat. This is the time to do it. So our stock's going to go higher. Is real estate going higher from here? Is it going to be a good strategy to just hold on tight to stocks over the next 5-10 years? Or do you start looking for other strategies? Do you start looking for ways to have zero counterparty risk in the market? Is it time to start making a move into precious metals? Give us a call, 1-877-8-SILVER, the website, guildhallwealth.com. That does it for another episode of The Real Money Show. So much fun to talk to you, Jerry. And by the way, I didn't even drink a coffee today while we're doing this. So there you go. So excited. Thank you again. Thank you to all our listeners as usual, and we can't wait to speak to you next week here on The Real Money Show on AM 640.